Well, the Bank of Canada has hiked interest rates to 1.75%, and many people now wondering what this means for them. Joining us now with more is mortgage broker Calla. Good morning, Angela.
Good morning, Paul.
Yeah, thanks for joining us. And I want to say that this comes as a shock, but this really wasn't much of a surprise, was it?
Not at all. We started proactively letting people know in variable rates in April that we expected 2 increases. Really having the trade deal completed was what was going to solidify exactly when that second increase was. We expected it back in September, but since things weren't finalized, here we are having it here in October. So we knew about it, and if you have a mortgage and a great mortgage provider, you were able to plan accordingly and make your decision with comfort.
Okay, and so what goes into that now? Because, I mean, anyone who's in debt, they feel like I can't even get my head above water here. So what can they do moving forward?
Well, you can always protect yourself against future payment shock by making increases to your mortgage payment to follow what's happening in the mortgage market when you have a mortgage. When you have a mortgage, it's important to have the proactive mortgage strategy to ensure that regardless of what happens with interest rates, and we all know interest rates are going to continually go up gradually, you can protect yourself against future payment shock and protect your equity.
Okay, well, but for the average BC resident, how much or more are they going to be paying? And what is another way that they can maybe prepare for that if it does jump up again?
Well, the increase was 25 basis points, so that's $13 per $100,000 in mortgage.
Wow.
So with that in anticipation, if you have a variable rate mortgage and it's prime minus 50 or less than that, it might be the sweet spot for you to lock in right now. And if you have a discount greater, depending on what your strategy is and how you're prepaying your mortgage, will depend on what the best strategy is for you. Also, keeping in consideration who your lender is and what your plans are for the next 1 to 3 years.
You kind of touched on it there, Angela, and I really think that's interesting. What is the best type of mortgage to maybe be looking at right now?
Well, right now, it really depends on what your specific qualifications are. It depends on your credit. It depends on your income. The most important thing is aligning yourself with a lender that has the lowest exit strategy. So regardless of what's happening with interest rates, you always have the ability to modify your mortgage. There's monoline lenders out there that have very good interest rates right now, below 4%. And if you ever need to move up the property ladder or you want to get rid of your mortgage to refinance some outside debt, that is usually the most significant contributing factor. When you have a mortgage, you have the option to refinance your mortgage, place your debt inside your mortgage, improve your cash flow. And with traditional lenders, the penalty can be 3 to 5%
Wow.
of the outstanding balance, whereas monoline lenders are generally 1% or below.
Yeah.
So there's a big difference depending on who your lender selection is. And once you have your income and your credit evaluated by an independent mortgage professional, they can show you all the options that are applicable to you.
Yeah, it is really interesting, Angela, but I mean, when you look at that, and I mean, just recently, people, if they're trying to get a mortgage or buy a home for first-time home buyers, they had to go through the stress test, and now we're seeing these rates continue to go up. Do you think it's deterring more people from just, renting or maybe living with mom and dad?
It certainly is, but right now we do have a balancing act. The supply on the market isn't going as fast as it was. In some areas, we have more than 11 months of supply, and because we're not seeing improving qualifications, these prices are coming down. So it certainly isn't easier for Canadians due to the stress test. It is making it more difficult, but we are seeing some prices in some areas coming down a little bit to give a little bit of relief to those home buyers. But when they did take a variable rate mortgage in the first place, the stress test is set out so they are aware of what to expect when interest rates will rise, because interest rates don't stay low forever and they don't stay high forever. So you have to be modifying it consistently to make sure that you're optimizing your mortgage.
When it comes to talking about money, you are always a wealth of knowledge. Angela Calla, thank you very much for your time.
Pleasure to be here. Thanks.